When you're building a business, the structure you choose isn't just paperwork. It has real consequences for how you're taxed, how much risk you take on personally, and how your business can grow. Whether you're just starting out or thinking about restructuring, it's worth understanding the core differences between the main types of business entities. This guide will walk you through the more common business entity types: sole proprietorships, general partnerships, LLCs, S-Corps, and C-Corps, explaining their key differences in liability, taxation, complexity, and suitability for the various business stages. My aim is to provide clear, actionable information to help you make an informed decision. The sole proprietorship is the simplest and most common way to operate a business. If you're running things solo and haven't formally registered as a business entity with your state, chances are you're already a sole proprietor by default. The main upside here is simplicity in setup and taxes. There's no need for formal registration beyond any local licenses, and profits or loss are reported directly through your personal income tax return, making filing relatively straightforward. However, this simplicity has a significant drawback. There's unlimited personal liability. Because there's no legal separation between you and the business, your personal assets such as savings, a car, a home, are at risk should the business incur any debt or sued. On the tax side, you'll also pay self-employment tax, which is Social Security and Medicare, on the totality of your net income. There's no legal way to split your income to reduce your payroll tax burden. In short, sole proprietorships are fine for testing out an idea or running a low-risk side hustle, but they can become a liability in the most literal sense as soon as you start to grow. If you're going into business with someone else and don't form an LLC or a corporation, you're likely operating as a general partnership by default. Like sole proprietorships, partnerships are pass-through entities, meaning that the business doesn't pay its own taxes. Instead, profits or losses flow through to the partner's individual tax returns. A partnership is easy to form. Often just a handshake and an agreement will suffice. But the lack of formality can be dangerous. A critical vulnerability is operating without a clear written partnership agreement. This document should explicitly detail ownership percentages, profit and loss distribution, responsibilities in the day-to-day operations of the business, and crucial procedures for dispute resolution, partner departure, or dissolution of the entity in its entirety. Without it, disagreements over finances or business direction can quickly escalate into costly legal battles. The biggest concern, again, is liability. In a general partnership, each partner is personally liable for the actions of the business and for the actions of the other partner at that same cost. One bad decision by your partner could financially wreck you. On the tax side, you're also on the hook for self-employment taxes on your share of the profits. Partnerships can work when trust is strong and risk is low, but without a formal structure and legal safeguards, you may have unnecessary liability exposure. For solo business owners who want simplicity and liability protection, the single-member LLC is a powerful option. Legally, an LLC, otherwise known as a limited liability company, is a separate entity from you as an individual, meaning your personal assets are protected if the business faces a lawsuit or debt collection, as long as you follow basic corporate formalities. This includes keeping business and personal finances separate, such as separate bank accounts, and, depending on your state, may involve things like holding regular meetings or filing annual reports. From a tax perspective, the IRS treats a single-member LLC as a disregarded entity by default. That means your business doesn't pay its own taxes and all profits flow through to your personal return, just like sole proprietorships. You still pay income tax and self-employment tax on all profits, but you gain legal protection, which is a major upgrade. One of the best features of an LLC is its flexibility. As your business grows, you can choose to have the LLC taxed as an S-Corp or even a C-Corp, giving you more options for managing taxes. And since LLCs are recognized by all 50 states, they offer a good balance of legal protection and ease of use. If you're serious about your business, but not yet ready to take on the complexity of a corporation, a single-member LLC is often the smart move. Once your business is generating consistent profits, it might make sense to elect for S-Corporation status. The S-Corp is not a distinct business entity in itself, but rather a special tax election that an eligible LLC or C-Corporation can make. Its primary attraction for profitable business is the potential for significant savings on self-employment tax. As an S-Corp owner actively working in the business, you must pay yourself a reasonable salary, which is subject to payroll taxes, which are, again, Social Security and Medicare. However, any remaining profits can be taken as distributions, which are generally not subject to self-employment taxes. Determining and documenting a reasonable salary is crucial and should reflect what similar businesses would pay for comparable services. The IRS scrutinizes this, so it's wise to research industry benchmarks and consult with a tax professional. You also get liability protection as long as you keep your business and personal finances separate and follow corporate formalities. But S corporations come with rules. You're limited to a maximum of 100 shareholders, all of whom must be U.S. citizens or residents, and can only issue one class of stock. You'll need to run payroll, file quarterly tax reports, and submit a separate tax return for the business. If you're earning more than you'd reasonably pay yourself in salary, and you want to protect your assets while legally reducing your tax bill, the S-Corp structure can be a great fit. C-Corps are the go-to structure for startups planning to raise money, issue stock, or scale aggressively, as well as for firms with sizable profits. They offer the most robust liability protection, the most flexibility in ownership, meaning there's no limit to the number or type of shareholders you can have, and can retain earnings within the business for future investment. The primary trade-off for this flexibility and protection is the potential for double taxation. First, the C-Corp pays a corporate income tax on its profit, which is currently a flat 21% tax on the federal level. Then, if those profits are distributed to shareholders as dividends, the shareholders pay personal income tax on that. While strategies exist to mitigate this, it is a key consideration. C-Corps also come with more complexity. You'll need a board of directors, formal bylaws, have annual meetings, and take detailed records of those meetings and processes along the way. You're also more likely to need legal and accounting help on an ongoing basis. For many small business owners, the C corporation structure is overkill, but if you're aiming to raise venture capital, issue employee stock options, or eventually go public, it could very well be the right vehicle for you. There's no one-size-fits-all answer when it comes to business structures. What works for a freelancer just starting out is very different from what makes sense for a tech startup looking to raise capital. For many solo entrepreneurs, starting as a single-member LLC and later electing for S-Corp status provides good balance between simplicity, protection, and tax savings. Partnerships need strong agreements and careful planning, and C corporations should be reserved for businesses with big growth ambitions and complex funding plans. The key is to choose the structure that aligns with your business's current stage, financial situation, as well as future ambitions. As your business evolves, your needs may change, and restructuring might become beneficial. I recommend reviewing your business structure periodically with legal and financial professionals to ensure it continues to serve your best interests.